Great. So we were discussing about this break-even analysis. Any questions? And so far we have taken cases of where the cost is linearly proportional to the quantity versus the price is also a linear or non-linear function. Depending upon that, you can have combinations of curves, different type of curves we have seen, and you can estimate the break-even point where the profits and the losses are, or profits and the cost, revenues and the costs are same. And you can also, in certain nonlinear functions, you can differentiate to obtain the point where you are expecting to have maximum profit, right? And I also gave you examples. And then this alternate names of the same concepts, essentially in terms of the marginal cost and the marginal revenue. It's nothing new. It's just sometimes you can have that language in the question. So don't get confused of what is being asked to you. We solved a question, and this second question is also there. It's not 100% very well defined. I'm not super proud of this slide, but it's essentially a nonlinear function. So far we have seen a quadratic equation. It's in a square root form. So ultimately it ends up becoming a quadratic equation. But let me just solve an example for you here. So suppose you have the price as a function of n is the number of unit has been given to you in this particular case, which is 21,000 divided by root n, right? It could be some function, it could be a product which follows this curve. You have an indirect cost or the direct cost, which is $1,000 per unit, and then there is some indirect cost which is $1,000 per period. So you have to be aware the quantity. So essentially there are two different dimensions here. One side is on the unit, which is the per unit production. Other side is on the time unit. So definitely you need to have some estimation of how much quantities are being produced in a given unit of time. Those kind of relations you will be required. So yeah, in real world, some of these multiplication, division of factors here and there might be needed. So that's the idea, right? So, and the number of units is 10 in this particular case. So your Z is your revenue minus the total cost function, which is N into P minus N into DC minus the IC. Now here I have not given you the, I've actually not given you the how much quantity is being produced in per unit time sort of a relationship. Ideally you should have the units balance this equation, and therefore that factor will get multiplied or divided. Here assume that the value is simply 1. So you can directly use this formula, but essentially you are able to make this relationship where Z becomes a function of N in terms of this relationship. This is not too tough to obtain, I suppose. And when you want to estimate the break-even point, all you do is equate this function to 0 to get the roots, and otherwise dz by dn, and equate that function to 0 to get the area point where the profit would be maximum. All right. So when you put z equals to 0, this becomes right. You'll have to rearrange a little bit, but because the term is root n here, it actually is a quadratic equation. So it will also have a two answers, and similarly, so you can actually convert this particular equation, take the square of both sides expression. So this expression turns out to be this simple expression. You rearrange. Quadratic formula you know, right? Minus b plus minus upon where? This is the equation that you are solving in a quadratic. A, b and c are the coefficient of x square, x and the constant. And if this is the equation, then the solution of the equation becomes these two roots are there, right? So you can obtain that. And when you do the dz by dn equals to 0, n comes out to be 110. So this is where you will have the maximum profit, right? So yeah, the real exam question doesn't have to be only a square root kind of a thing. It could be other quadratic equations or something, but read the information carefully in terms of what is being asked to you. Just because it has quadratic equation does not mean you start solving a quadratic equation. The solution could be simply about where is the maximum profit. In this case, you are not even required to solve for the roots. You are only required for differentiation and then solve for the answer, right? So read. A lot of information could be just misleading. So be careful about those kind of questions. All right. So then let me also introduce a slightly different variation of a term that we have already seen. Previously we have discussed this term called payback period, right? This is the time that it requires for your cash flow to be returned, or at least become zero, original investment to return to the same value. But you remember in this payback period analysis when we did not consider the time value of money, right? But you could ideally do consider that, and therefore there is another concept called discounted payback period, which is the time it takes for to recoup your investment when you are considering the time value of money also into the analysis, right? So it's very simple. There are two types of payback analysis. No return, it means the interest rate or the MARR is zero, so that becomes a simple payback, and that is when you say payback, that is what we mean, right? But when the I has some value which is greater than zero, then you will call it as a discounted payback series. In the normal cash flow, how did we estimate the number of periods where it becomes like the payback period is essentially this initial cost and the sum of the cash flow series you started taking, right? And then you equate this to zero to obtain the period at which the cash flow becomes, the total sum of the cash flow becomes zero on both positive sides, and the negative side become equal. When you have to do the discounting, essentially you are calculating the present worth of each of the new term coming up, and then you find the period at which the present worth just starts becoming zero, right? So here I am multiplying each cash flow by the P by F factor. So I am calculating a present worth of that cash flow, and using this formula you can still estimate the discounted payback period for a given discount rate. Okay, not a very tough concept to grasp at this stage, but this is how the new concept is. All right, so yeah, this is what we have. The payback period is, or in general, this analysis is quite simple, but quite powerful. You might face this decision very more often than not in terms of what quantity should you buy, or what kind of mode should you have to procure that particular quantity. In those analysis, it becomes very handy and quite a useful concept. Any doubts? Okay, everyone fine with this? So let me start a new topic, which is, okay. Anyone here knows the term depreciation? What is depreciation? Decrease in the value of a particular asset. What else? That's the only concept about depreciation. Why does this value depreciates? Something might got out of date. The technology evolves so much that the old thing has no value. What about others? Examples? Building value depreciates because of construction. Like the building is becoming older. So as it ages, its value goes down. Why? Deterioration in the performance, maybe material is getting old, you might have cracks here and there, you start using, the walls become dirty and things like that. Okay, what else? Yeah, that's because of technology change. Mostly technology change. The components are anyhow same price, similarly priced, but yeah, technology change. Or technology change could also make the unit cost cheaper, but still the value goes down because those features are no longer necessary for users, so they are not willing to pay for it, right? So the price could go down. Any other ideas? So when there is a surplus quantity, the price goes down. So see, this is, yeah, thank you for bringing that point. So that is not depreciation. That's just a price game. Depreciation is the value once you have obtained the asset, it starts decreasing. Not at the time of obtaining what was its value and whether you were competing in a discount was there or not discount was there. Those kind of things are slightly dealt differently, right? So it's not the price. It's basically once you've acquired, the value of the asset goes down. Okay. Any other? Anyone else? Any other ideas about depreciation? So yeah, you are perfectly right about it. So depreciation is essentially loss in value of a property such as machines, building, vehicles, or any other investment over a period of time caused by many of the factors. So first is the wear and tear. And if you do not repair a particular equipment, it will soon go out of production. You will not be able to use it. So it's of course, it could also be dependent upon how heavily do you use the machinery. If you are using one machinery more than like too intensely versus less intensely, in real world, the machine which is being used more is expected to also break down more often or wear tear more often, right? And also how much maintenance you have been able to do, not only the usage but also maintenance. For example, there could be machine which you use much frequently, but then you are also putting regular effort to keep it on a good condition, maintain it, clean it, do the oiling to the parts and all. So that could still make the life worth. But then there could be one machine which receives no maintenance and therefore its wear and tear is much more, right? In general, deterioration, so even if you do maintenance and all, doesn't matter. There are certain aspects which gradually over time deteriorates, right? For example, concrete structures. So no matter how well you take care of or how well you clean your concrete structures, they are in an exposed environment. Some harmful chemicals are completely always attacking them or getting absorbed by the concrete, and therefore there is a natural decaying process that happens. And of course, in this condition, it will depend upon what kind of environment you are dealing. For example, concrete deteriorates faster in coastal areas compared to in a normal area where not so much exposure to sea salts are there, right? Things like that. Or yeah, in this case, it's also like in general, machinery with moving parts are much more likely to break often because they are always friction and heat and all those things are happening. So there's a natural mechanism for them to deteriorate in the performance. The technical evolution. So the things is no longer useful. It's completely obsolete for your use cases. So that depreciates. And in general, reduced demand. You said it, but again, I just wanted to make a point in terms of the price versus the depreciation, right? So price is when you're buying at that time, okay, this could be the price. And since it is no longer in demand, sometimes the price can go low. But depreciation is a concept which is applicable after you have acquired the asset, usually, right? Surprisingly, not all of these factors work in the same manner. So recently, I'm actually procuring some computers for our lab. And these are some reasonably high-end workstations that we are procuring. So I defined a slightly older chipset, okay? I didn't know what was the newest generation chipset. So I said that this is a slightly older so that at least I will get something better than that, right? That was my intention. But because the vendor wants to get that old chipset, it is more expensive for them to get that old chipset, but they still want to satisfy my criteria. So I'm getting a older piece of machinery at a higher price because the vendor is having more cost to acquire that old machinery. So yeah, it's a tricky concept. Just because things are old does not mean that they will cost less. You have to think about that a little bit. And of course, we have also seen that some things they appreciate in value. We have discussed those examples also, right? Some of the assets, particularly like land or even in case vehicle. Suppose your construction equipment becomes so what a classic kind of a construction equipment where people started suddenly like, oh, this Caterpillar equipment was so fascinating, and it becomes a collector's item, and then you want to appreciate the value. So things can happen, but this is the general sense of it, right? All of you are okay or spoken correctly, but what we are dealing with is the depreciation in accounting processes. It has some connection, but more or less it is disconnected with the real factors causing the depreciation. What we are going to deal with, at least in our case, is how depreciation as a concept is used in accounting purposes, right? Accounting is essentially your cash flow related. How does it affect the cash flows? What is the purpose of a tax benefits of depreciation? Do you know that depreciating asset gets you a tax benefit? Are you guys aware of that concept? Is anyone? You are aware. But we will come to that, right? So we are going to deal with essentially how depreciation is handled in financing and accounting perspective, not from a perspective of whether it is actually that much valuable or not. Okay, so it's slightly different. Some of the factors that we discussed could contribute to this depreciation, but then most of the time the accounting practice has predetermined formulas on how will you calculate the depreciation amount, and you are supposed to or expected to use those formulas rather than going and measuring actual usage or actual level of preventive maintenance of each asset and trying to see what is its current value and things like that, right? So it's a slightly disconnected concept, but remember, in our course we are more worried about the depreciation from an accounting perspective, not from the real usage pattern, right? So this is the idea is that fact that any asset bought now is worth less in future is taken into account. So the concept is same. You are assuming that the value of an asset is going to go down, and therefore something needs to be done about this, because you bought it 1 year ago at some value. Now this is not on the same value. It has some impact in terms of your business. It has some impact in terms of your cash flows. It has some impact in terms of your profit loss statements. All of these we will look into this course, but there is something to be done, and that's the concept we are going to deal with, right? Ideally, this is the amount that depreciates for your asset. You can actually get a tax rebate on that. What happens if, suppose you have an income of whatever I value, and you can show that in total your entire assets that were required to generate this income, they also depreciated by, let's say, an amount D in that particular time period. So then your net income will be I minus D. Tax calculation happens on your net income, not on the initial income I that I have told you or the revenue that you have generated, but this tax calculation that happens on this one. So since you are reducing the amount taxable, you are essentially giving some benefits, tax benefits to the people, because they have to pay lesser tax, and therefore some extra money can be saved within the company, right? So this is the definition of, I think this is a concept more or less related to businesses, companies and everything. For individuals, there are similar concepts in terms of your investments and the value of your investment changing over time. The taxation system allows that kind of concepts into personal income calculation, but this concept as a depreciation amount is related to this. But it's not uniform. In India, that's the case. For example, in Japan, when I used to file for income tax, even as a student, there was like you have certain columns in terms of the amount that you had to spend in order to get this income. For example, I will do some part-time job, teaching job and all. In that case, whatever the transportation expenses that I incurred, I could give a receipt and say that, okay, this is not my net income because I had to incur some cost in order to reach to the place where I was teaching, and therefore do not charge me tax on the amount that I got, but amount minus the transportation. And in that case, if you could prove, for example, you are a freelancer and you use computer to do your work, you could show that, okay, my computer that I had bought was 2 lakh rupees in the first year, now it is 150, so that much depreciation has occurred, so please allow me a tax benefit on that. You could calculate that, but it is, I don't think that concept exists in India. You're deducted at source and all those things are there, so I'm not aware. So accounting in general has 2 different types of sheets. One is the balance sheet, which has your total assets and your total liabilities concepts, and then there is a revenue and cost and profit and loss statement. These are 2 independent statements. We will look into that towards the end of the course. Don't confuse them right now. Okay, these transactions have a specific way how they are accounted for in terms of your books. They all add up. There is no double counting in accounting. It's very mathematically defined. Simply they have notions on how to use and where will it be accounted for. So that's not a problem. Okay, right. One important thing to notice, and this is a 1 mark question for you, it's not an actual cash flow. Depreciation is not an actual cash flow. There is no money going out of your system, right? You bought it, your money went out of your system when you bought a new asset. Now it's just that the value of that asset is going down, but you are not paying again to buy that reduced price asset, right? The money has already gone out of system. So there is no real cash flow. Depreciation amount is not cash flow, but it can influence the cash flow. How? Precisely what I've shown you here. If the asset was not allowed to be depreciated, your income, taxable income was this slightly higher value, corresponding to, let's say you get some 0.3 values or 30% of tax, let's say. So this is your taxable income. So your net revenue is what? Or net income that you finally got in hands or something that you could use for your business is essentially this minus this another 0.3i component, right? But now when I'm allowing you to get the tax benefits, the total taxable amount I have decreased slightly. So the total tax amount also is decreased slightly. So the net remaining in your business is slightly higher compared to. So it has potential to influence cash flow, but depreciation itself is not a cash flow. Got the idea? What I'm trying to explain? So nobody says you are not putting this money aside somewhere like depreciated amount. It's just the value of that asset is going down. But calculation wise, tax benefit wise, it can influence the net cash flow that is being generated in a particular business or a particular equipment and things like that. Okay, is this concept clear? We will look at these examples, we will do the calculations, but right now the conceptually this is how we are going to treat it. So the typical flow or the graph of the value, what I've done here is I've taken one particular asset and I have plotted its value each year, and this graph is typically the depreciating curve. There could be many forms and shapes of this, we will look into it, but there are certain key variables that you need to take into account when we are doing the analysis, which I will introduce from now onwards. But this is the general trend. All I've done is I have plotted the value of the asset over time and it is showing that decreasing. That's the depreciation part. Okay. Now let me introduce why government gives the tax benefit on depreciation. Still get an idea based on the mini calculation that we did. Why does government allow tax benefit on depreciation? Any idea? Stop reading. Such a long sentences. But the idea is, suppose your asset actually breaks down after 5 years. If you don't put money aside to replace that asset when you need it again, you will go bankrupt, right? You will not have any asset or a machine which you can use to generate your revenues or do your business. So the government is giving you tax benefit, that ideally the money that you are saving from this tax benefit, you should keep aside so that when you actually need the money to buy the new equipment, you can use this money to just purchase that equipment. So replenish your old asset, replace it with a new asset when you actually need it. That's why this benefit is given to you. But of course, there's a flexibility because ultimately it's a money saved to you. You are free to do whatever. You could invest it somewhere. Suppose you are expecting that your asset renewal will happen maybe 3 or 4 years down the line, but you are at the savings right now. You could perhaps invest that money in certain so that it generates more money, and those kind of things are still possible. You could play with, there's a flexibility. But the purpose of the government is that they do not want you to go bankrupt. Government actually likes people are doing business because they are getting the 0.3i, which is a huge money. Once you will earn money, you will realize the value of this 0.3. It's a huge money that they are getting. So they don't want businesses to go down. And in general, businesses going down is not good for economy. People lose their jobs, families get disrupted. It's not a good situation anyone wants to be in. So they actually want you to safeguard that, okay, by the time 5 years, no matter how you use your machine or not, it is bound to be unoperational, like because of so much factors. Because physically there are factors which will make it unusable. At that time, you should be able to replace it so that your business can continue. If you do not have new machine, you will not be able to operate. If you do not have new land, you will not be able to operate. So that's the basic idea, right? Still with me on this? Why does government give a tax benefit on depreciation? So yeah, essentially if the company has to replace an expensive equipment in a given year, it is not advisable to use all the funds from net profit of 1 year alone. What happens is, suppose you have a suppose you are dealing with a monthly revenue of some 10 lakh rupees. But your machinery itself requires a 1 crore rupee kind of a machinery. So if you buy that in only that year, your net books will be like hugely, like losses will be there, right? Huge losses you will have to show. And that's also not good indicator of financial health of your company and all. So they ask you that you, every year you take some money, you keep it stored somewhere for a long time, so that when you actually need to replace the asset, you are able to do it, right? So it is important that funds are set aside every year during its service to facilitate the replacement. It may be also noted that expensive is only technical in nature and the funds are not actually transferred out of the system. There is no, the tax benefit that you have incurred, it still remains within the company. You still have hold of it. It is not actually, the depreciating amount is actually not given out of the system. And it could be finally used for replacing and buying the equipment. So it's basically allowed tax benefit for fund being set aside for procurement of equipment, generation of capital, etc. in the future. Yeah, we will look into those cases. So ultimately, government decides that depending upon the class of assets, they get, complications can be there. But there are ways by which they will finally, you will be able to charge only that much that is allowed by, as per the tax laws. So they have ways in order to identify this much depreciation you have already taken into account for this machine. Now you are eligible only for this. If there is a balance, if you have overcharged, you'll have to pay taxes on that money. Yeah, there are proper guidelines, and if you are adhering to the government taxation system, if you want to do business in India, you need to adhere to those norms. If you're not, if in audit you are caught, then your license goes away, right? So at least tax authorities in India, they are quite powerful that way. So you have to do that, right? So yeah, essentially that's the idea. Just go again and look at some of these things. It's basically fund available to replace your equipment. If it's not, yeah, one thing is, suppose the government allowed depreciation for 5 years. They also have ways on to estimate the service life. That service life is different from the actual service life. The taxation purpose service life could be, suppose on government estimates that on an average, the laptop become unusable after 5 years. Because the technology changes so much, the software changes so much, practically you can't use that laptop. But real laptop could be working after 5 years also. So in that case, that becomes your bonus. That you have an asset which you have taken full advantage of its depreciation. So you have practically saved money to buy a new one, but your old asset is working. So that's a bonus for you. You could use that to scale up your business if you want. So that's there. But government is happy because at least they had done their financial calculation and you adhere to their norms accordingly, right? So that can happen. But if you, so that we'll also see sometimes what happens is they start calculating depreciation by one method, but then they realize that if you keep on using this method, you will not match the final value that you are supposed to match. So you can actually change the method of calculating the depreciation. We'll look at all those examples in this particular topic. Okay. All right. So this is the most scary slide. Essentially going to this graph that I plotted. Remember, just a few slides ago, I had plotted this graph. This is the time period starting at some number of intervals. This is the book value. I'm going to explain what is the book value. So the initial point on this curve is called the first cost. It is usually denoted either capital P, or it is also called unadjusted basis, capital B. Not my terms. I have not made this formula. This is what they use. I have to make sure that in case you are asked this in exam, you are able to understand this. First cost, that cost that you were required to acquire this particular equipment, or it's called unadjusted basis. Unadjusted basis means it's essentially not adjusted for your depreciation. So your base value is essentially your unadjusted basis. That's where the name comes from, right? So it's the capital investment required to own the equipment, which includes cost, purchase cost, any sales tax, any transportation costs involved in bringing the equipment to the company's store, cost of assembly, installation, everything. Total how much you paid in order to get this asset operational in your business is the first cost. So for example, you need you buy a phone for just 50,000 rupees for your piece, but then you need to integrate that with your cash billing machine or something, and there will be some person coming and delivery charges and all. So that's part of your business. It's not the only cost of the phone, but also integrating so that it starts becoming operational for your purposes. That's the total cost you are including here. Okay. Then salvage value, it's shown using capital S. We already know salvage value. It's essentially the value of the asset at the end of its useful service life. Okay. It does not include, normally it does not include the cost of dismantling and removal, but could go to negative when included. So what happens is, this is essentially the kind of value that you will be able to get if you just straight away sell this. But sometimes it might happen that you need to scrap particular thing. For example, electronic waste. There were time in India when electronic waste payers, like if you send somebody to collect the waste, they will pay you. But now we are also living in a time where they will charge you to scrap your waste. So depending upon whether you have a dismantling cost associated with equipment, this salvage value could also go to negative, right? But in accounting terms, salvage value is always greater than equal to 0. You are not allowing it to go below than 0 in taxation purpose. Real salvage value could even be negative for you, right? That you are actually, like when I left Japan, I remember clearly that I had to pay some good $200, $300 to my municipality corporation where I was living to take away all the garbage that I had generated, and that's a huge money. While in India, you are used to of somebody paying you to take your waste, especially the Raddi wala, the Kabadi wala system that we have. But in many developed countries, that's not the luxury. So that could be a proper cost associated for you to terminate the service life, right? In general, service life, or more precisely what we call in the financial term or accounting term, is the recovery period. So it's the number of time periods for which asset is allowed to be depreciated. This time period, the number that I'm plotting here, it's again only a financial and accounting purposes. The actual service life of the equipment could be higher, lower than this value. But this is the financial purposes they define. Typically, they have all the taxation when you do the company wise, they have like, okay, heavy machinery, they take it 5 years. Some really specialized equipments, maybe 10 years. So they define this in the tax laws. Okay, you will be given this information, may be able to access this information. This time period, which is the allowable recovery period, could be different compared to the actual service life of the equipment, right? So the concepts are similar, but they still are disconnected from the reality. Don't confused about those things. If I give you two values of service life in the question, you should be able to recognize which one to use for the purpose of depreciation. Okay, that's why I'm introducing these now. Then book value at any point of time t is denoted using this notation BV with the subscript of t. So essentially, this is what this curve is actually book value curve. So this value is book value at the end of year 1. This is book value at the end of year 2. This is book value at the end of year n. And this is book value at the end of year 0 and things like that. Again, book value could be different compared to the real value of the asset. It could be derived on that, but typically it is governed by the depreciation formula that you are using. The depreciation formula will be able to immediately tell you what is the expected book value from an accounting perspective. But the actual book value could be different. Ideally, this book value should be the current value, current market price of the machinery. So if you were to sell this machinery today, however, how much money you are able to get, that should be, but that's not, that could be one factor to determine it, but this is not the absolute. It is typically the moment you define the type of equations you are going to use for depreciation, this book value calculation becomes automatic, predefined formulas. Okay. And then finally, the depreciation rate, which is small d with the subscript t. It's the fraction of the first cost minus the salvage value, which is removed as a depreciation amount in each year. So again, in this curve, I can show you better. So the unadjusted basis, capital B, the annual depreciate, all these are individual book values at time period T. This n equals to 10 is shown as the recovery period. This particular book value at the end of the recovery period is your salvage value S. The amount that you depreciated in a year is represented some sort of a DT. This DT changes, the definition of DT changes depending upon what exactly you are, which method you are using, but essentially it's some sort of a fraction of the original value that you depreciated in this particular year, right? That's what it's called, DT. So this DT, for example, if I give you, let's say this is 100, so in this particular period the DT would be somewhere 0.2, because your new book value is what? 80% of the original, so the depreciated amount is the 20% of the original, so that is given here. Then for this period, this could be slightly different value. You could have a idea, calculate using that. Okay, clear? Notations wise, all complicated or able to understand? All right. So now there are many methods of depreciation. There is something called straight line method. This is a very simplified model, no longer used anywhere in the world, but it's very commonly used as a concept teaching. There's something called sum of years method, which was very commonly accepted in previous tax laws. Again, majority of countries in the world do no longer use it. There's something called declining balance method, and in this particular there are two types, only declining and then there's a double declining balance. We will look into this into more detail. Most of the countries are using this kind of a double declining balance method to estimate the depreciation amount. There's something called sinking fund method and there's something called unit of production method. There could be multiple ways to define this. It's that in the country or region that you are operating in, which tax laws govern what, and you have to test the method from there. So let's go to the straight line method, starting with the first easy method. The idea is the book value decreases linearly with time. So what could be a trend that you could expect? This or this? A or B? But essentially the book value will show a negative line slope like this. That could be the amount of depreciation. That could still be the answer, but yeah. So that's the idea. So how do you calculate? Essentially, if you want to define a line, what do you need? You just need one point at which it passes and you need a slope. You know the original point where it will pass, which is the initial B value at the time 0. You know this point. So all you need to estimate is the slope of the line to define this completely. How do you estimate the slope? Is essentially, let's say you have a book value at the beginning period and then you have a salvage value. So, and the number of periods is n. So the total value that you need to depreciate is B minus S. You have to distribute it equally over n number of periods. So that becomes your depreciation rate for each period, right? So this annual depreciation charge, again, pay attention to this. This was originally denoted as small d and subscript T. But here, since it's an annual, only in the linear, sometimes it comes on the capital D and small subscript T. Don't worry, I will not ask you a question what is capital D and what is small d and all. Just get the idea. Just don't stick to a single definition when it comes to depreciation fraction that we're talking about, right? So here, the total amount that you have to depreciate is the initial book value minus the salvage value, and in per period what is the rate, and that per period rate is B minus S divided by n, right? So if you have to estimate the book value at any time t, you have to subtract from the original book value or the unadjusted basis the number of periods multiplied by this unit depreciation rate, right? So, or you could ideally write it in a simple manner. BV at any point of time t is equal to book value at any point of time t minus 1 minus the depreciation amount in that time period t. You could also denote using this formula. And in a linear case, this becomes the answer. Sure? Cool. The small dt, the depreciation rate, which is the fraction at which each of this value is going to go down, can be defined as simply 1 minus n. You just keep on multiplying that formula. That is essentially your slope. Okay? Linear formula is pretty easy, I suppose. Then there is something called sum of years method. SOY. Don't ask me why this formula came. There is of course, reasoning to it, but no longer useful for you. I'll still give you some general idea of a linear depreciation versus a non-linear depreciation. What is the advantage and disadvantage of that? That we will discuss. But whether the non-linear is this or non-linear is this versus non-linear is this, we will not go too much into detail, but these are some of the methods that exist in the literature, right? So, sum of years method is most of the depreciation associated with any asset is recognized in the first few years, then at the later stage. What is happening in a linear one? The amount of depreciation is equal every year. But when you are having a curve like this, in this kind of a curve, you are allowing higher depreciation amount in the beginning period. Can you relate? Basically, your depreciation amount is this kind of a vertical line, right? No. No. Essentially, depreciation is coming from the subtraction of the curve, right? So in the beginning, your book value goes down quite high. So your depreciation is higher in the beginning period, and then you will see that later this curve kind of flattens out. So even if the number of years are passing, the depreciation amount is not increasing too much, right? So you have allowed much of depreciation to happen early. Can you guess reason why? Any idea? The idea is, her thought is that since the product is right now in demand, and maybe as the year passes by, it does not remain in demand anymore. So you may want to replace it sooner than the later. So it's essentially you are allowing the depreciation in the beginning. Interesting thought. I never thought of that way. Any other explanation? Anyone heard about this before? Yeah. So essentially, the main value addition that you are giving to the business is you are allowing them some sort of a benefit, right? You are allowing them to gain benefits early in the life of the product compared to later. What happens is when you allow the larger depreciation in the beginning, the tax benefits are larger in the first half of the cash flow series, like the first part of the cash flow series. The larger benefits in the first part will lead to higher positive of this whole investment. So essentially you are taking care of the business that, okay, this is not a law to kind of penalize you. Essentially it is to support you for buying those things. So you allow depreciation so that people actually do genuine. So there is an incentive for people to file good depreciation amount rather than actually withholding the information, right? So it works both way. Government does not want to kill businesses, but in saving taxes, they might kill their own businesses. So that is what government is also giving them incentive, that you take the benefits early in the product stage rather than wait for the end to adjust all those things, right? And of course, the higher the slope, the better this condition becomes, because the present worth of the net series will be higher and higher as the depreciation amount is higher in the initial phase. We'll come back to this concept later, but let me first introduce this formula. So, in this case, the annual depreciation charge can be estimated using this formula. This is, and again, this is something that you have to memorize perhaps, is depreciable years remaining at the beginning of year T. Okay, depreciable years remaining at the beginning of year T divided by sum of the year's digits multiplied by the total amount that you need to be depreciating, which is the B minus S. So this term is clear. Let me just explain you this. So for example, I have a, let me just first see, yeah, starts at 0, right? So at the, this is T equals to 1, this is T equals to 2, So at t equals to 1, the number of remaining periods to be depreciated are how many? Three or four? Sure. If your n is 4, t is 1, the total period it allows you to depreciate is 4, because there is a period convention change. Normally you are dealing with end of period convention. This is asking you for beginning of period convention. That's the trick in the formula. So essentially at t equals to 1, it says that you are allowed to depreciate for 4 periods if the total service life is 4 years. So therefore this additional term of plus 1, not the simple n minus t, but this n minus t plus 1, because there is a change in convention. Okay. And the sum of ES digit is essentially nothing but this, the series of, for example, if you have 4 periods, so 1 plus 2 plus 3 plus 4, this is sum of ES digits. If it is you have 6, then 1 plus 2 plus 3 plus 4 plus 5 plus 6, whatever that value will be. So if it is n period, there is a simple formula for this. This becomes to n into n plus 1 by 2. This you are aware, right? Sum of a geometric series of n terms is n into n plus 1 by 2. Consecutive integers are there, right? So this is pretty clear. So this is how the formula is calculated. So at any point of time t, the amount depreciation you can estimate using n minus t plus 1 divided by the sum of series into b minus s, right? Then the book value at any point of time t becomes the original unadjusted basis minus the depreciation amount that happened in each of the n years that you have so far passed. Correct? This is still remains the same original one that we had, same formula. Essentially, in this particular case, this was a constant value. In the SOY method, this will not be a constant value. Each time you will have a different depreciation amount. Okay? So there is no small dt that you can define here clearly, because each time the depreciation amount and the fraction is changing. But in the previous case, you could define that using a linear function. Yeah. It can be. So convex you mean like this. It can be. I will see a method, but it's not advisable from a tax benefit purpose. But yeah, it can be. So far with me, we have already covered 2 methods. I'll just introduce you with declining balance method, but we will start with on Monday on this particular topic. So in this case, so far what we had done was we were worried about the initial value, final value, and we depreciated that amount using some formulas. In the declining balance method, you are worried about the instantaneous book value. So it's some sort of a fixed percentage of the current book value, not the original unadjusted basis. In the 2 formulas, you were worried always about the unadjusted basis. That was your reference point. As the number of periods passed, you were still calculating from that original unadjusted basis. In this particular case, you are worried about the instantaneous. So for example, if 10% in the first year, so 100, if 100 was the value, after 1 year it becomes 90. So if in the next period, if still the depreciation is 10%, the 10% of 90, not the 10% of the 100. So I am worried about the instantaneous book value, and that is what we will look into it. I'll explain you in more detail, but that's the fundamental difference. The basis, the base keeps on changing in the declining balance method. Okay.